The expense side of the chart is where most of the money flows and where most of the disorganization shows up. Revenue goes into 8 buckets. Expenses go into 14 categories, each pre-mapped to a Schedule C line on the tax filing side. The setup work is mechanical and one-time. The cost of skipping it shows up in April every year, paid in CPA billable hours at judgment work rates. The math on this one is unforgiving. The setup is an evening of work done once that you will never repeat. The miscellaneous bucket path costs you that same evening every April, charged at billable hour rates for as long as the practice exists. 5 years in, the cumulative cost difference is real money, not a judgment call, just arithmetic. The principle: every expense category maps to a named Schedule C line or named IRS deduction category. Miscellaneous is not a deduction category, neither is office stuff. Both labels guarantee that someone, usually your CPA in April, has to reconstruct the year's spending from a stack of receipts and bank entries to figure out what each charge actually was. Most of these are line items every CPA recognizes on site. The two that get coaches into trouble are supervision and mentor coaching, because they sound like education, but they sit on the education line only when the ordinary and necessary test from Unit 7.8 actually clears. If supervision is a credential requirement rather than skill development, the deduction story is cleaner. If it is genuinely developmental, you need the documentation to prove it. 3 of these get systematically underclaimed by coaches. Marketing is the biggest one. Coaches treat business development spend as overhead and forget it deducts on line 22. Contractor payments crossing $600 to any single individual trigger a 1099 NEC filing obligation in January, and missing that obligation gets expensive fast. ICF dues are a professional dues deduction the moment you pay them. None of these are exotic. They are just commonly missed. The instinct to combine these is understandable. They all feel like the same kind of purchase. The tax filing does not see them that way. A new laptop depreciates across several years. A Zoom subscription is a recurring deduction in the year you paid it. A box of pens is a one-time expense on a different line entirely. 3 filing rules, 3 lines, and 1 detective hour in April for every year you let them sit together. What is worth noticing in Priya's story is the multiplier. The $600 CPA reconstruction cost was not the worst part. The worst part was 3 years of business decisions made against unreliable category data. By the time the chart was clean, she had already overpaid on quarterly estimates because the expense ratio looked worse than it was. The 14 category setup paid for itself the first April. The category data starting clean from January paid for itself differently and harder to quantify. This is the principle behind keeping zero balance categories in the chart from day one. The cost of carrying an unused account is nothing. The cost of adding one mid-year after 18 months of rent has already been booked to a generic expense line, is a reclassification project nobody planned for, and the CPA will charge to untangle. Future you, claiming a new deduction in year 5, will present you for the empty line. One operational tip on the build. Do not just import the template and walk away. As you set each category, write a one-line description in the software's Memo field explaining what does and does not belong in that bucket. Future you will misclassify something in month 7, and the Memo field is what stops the mistake from compounding for the rest of the year.